Heidi ho, everyone, and welcome aboard. I'm not sure why you can't see me. It's a little bit weird. My camera doesn't appear to be working. This is Geoff coming to you, well, kind of live, but in the dark from Tasmania in Australia. And it's great to have you on board for our weekly market update. Thank you so much for joining us. I have absolutely no idea why you can't see me. Perhaps that'll fix itself as the show goes on. Let's hope so. According to me, everything is as it should be. But let's try and put something on the screen anyway and make it that. It is a look at gold versus the US dollar. And I noticed a few things when I was doing my analysis in the last few hours. No sound either. Really? Surely someone can hear me. That's not good if you can't hear me. Can you see my screen, guys? Okay, awesome. Thank you very much, everybody. That's fantastic. Okay, so notice a few things whilst I was doing my analysis a few hours ago. And on the main, I guess, pegs that we use, and I'm talking about gold, the S&P 500, the dollar index, and oil. Thank you very much indeed, Henry. Appreciate that. And each of three of these main concerns that we use actually put in higher highs and closed their lows this week. Interesting. Well, I believe it's interesting anyway. And gold is one of those that made a new high and closed on its low. By definition, that's a thing that we call a key reversal, certainly a market reversal. Now, whether that's pertinent across the board is something that I'm yet to determine. That's the S&P 500, exactly the same thing. Put in a new high, closed on its low, and looks to me to be in a very, very bearish mood. Oil, exactly the same thing, even off the monthly pivot. Put in a new high, closed on its low, or near its low, not exactly on its low. Something that I do look at in my currency, and I'll be doing that very, very shortly as well. There is one exception to that last week, and that was the dollar index itself, which is very, very interesting in my book. So we've got gold versus the dollar, new high, closed on its low. S&P 500, which of course is against the dollar, made a new high, closed on its low. Oil made a new high, closed on its low. But the dollar index itself did not make a new low and close on its closed on its high, suggesting that there's more upside to the US dollar. Now, our US dollar expert Orlando will be joining us in the not too distant future by video, and I'd be very, very interested to see what he's got to say, or hear what he's got to say about the US dollar and where it's headed. But before we do that, in fact, we're in the Southern Hemisphere all of the week this week in Sunday Market Update, because we're going very, very shortly to, if I can actually find the control panel here, we're going very, very shortly to the southern part of Africa, to our good friend George very, very shortly. So let's see if we can line that video up. I'm trying very hard to do that. And I'm sure I'll be with you in just a tick. Where are we? That's what we need. We need George up. Now, George, of course, is coming to us via video as well. And he will be doing a very interesting thing in the next few weeks. He's doing kind of an 8-hour scenario where he will be on every second Wednesday, I think it is, or the second Wednesday of the month. He'll be coming to us via the YouTube, the normal channels, and he'll be 8 hours in the day. Wow. Not sure how he's going to do that, but he'll explain that to you very, very shortly. Sadly, he has disappeared from my screen, and for that reason, I'm going to go to Orlando first up. And Orlando, as I said before, we'll be talking all about the US dollar. So let's go and talk to Orlando. The big O, here he comes. He's the biggest base in trading I know of. You probably can't hear that. Hang on 2 seconds. Not having a very good start here, are we? I need to share that. And my apologies, guys. I'm not doing this on purpose, I can assure you. Goodness gracious me. The control panel has gone again. New share sound. There we go. It should all be happening this time.
Hello traders, Trader O here, and let's talk about the US dollar. Last week, I was talking about possible deep buys on a retest of September 2019 highs, but that did not happen. As you can see, the DXY rejected this previous key level and completely and utterly rallied. Now, I'm still looking for buys, and on this short video, I'm going to show you what I'm actually expecting or what I am planning to do on, some days open, or for you Mondays open, right? Basically, the DXY closed very bullish above April 2020 highs. Just have a look at that daily chart. Extremely and utterly bullish. And if you remember my video from last week, I'm actually going to show you on the weekly, let's call it the 2 week range, the 2 week chart. We're looking, or actually the weekly chart. I was looking at this key level, right? Now, what I'm looking at on the daily at the moment, just delete this, right? What I'm looking at, I'm sorry, on the hourly, at the open is a retest of these previous broken highs, right? Now I'm looking for buys again, and this structure would yield a very nice risk to reward ratio on a buy here at a retest of April 19 and April 20th highs. So if the US dollar pulls back towards this level, or DXY pulls back towards the 101 level, right? And I see a clear rejection of this level. I would tell trader, I would be very happy to take buys here with candles, stop losses. And if we look at the daily, of course, I wouldn't be trading the DXY completely. I would be looking for possible with this key level. This was my bull bear level, which was the top of my no trade range. So I was not going to buy or look for buys inside of this range. That was because those buys have absolutely no edge. But now that price has broken with the 2020 level, I am more than happy to look for those longs on the USD by buying this market. Now I'm looking at not the previous week's highs, but the week before that, I'm sorry, lows, as that was the level that was capping the upside on the USD Mexican peso. So what I'm looking for is a pullback towards this level, right? You have to remember that support and resistance levels are actual levels, not straight lines on your chart. So the actual retest level that I am looking for on the USD Mexican is this. This one's right here. Stop losses on possible buys should and would be below the ultimate lows, right? Yeah, I mean, there's, I could, in fact, place stop losses below the structured lows, but because I am looking for a swing trade, to me, this, placing my stop losses below the structured lows would be too tight, right? So I'm looking for a retest of this zone right here. Should I see a clear rejection, I will place buys with stop losses below the bearish move lows, right? First target should be around this high, right? Because we have a clear path towards this next key level. And the risk to reward ratio on a possible buy here would, I mean, for first targets, right, would be around a 1.4 R. Now, if you choose to put your stop losses very tightly below the structured lows, that gives you a 2.9 R, right? That is not how I trade. I trade with wide stops, but you know, you do what you want to do. And let's look very quickly to finalize this video at the 8-hour chart. This zone is extremely thick, in the sense that big sell orders are possibly going to be placed here. More so, more selling pressure would come from, you know, midterm buyers taking profit should this scenario play out, of course. But I would take about 75% of my trade here, and you know, keep my buys, or the rest of or the rest of my trade for a break of the 2080 level and a bullish continuation. The reason is because I am very bullish on the US dollar, and just looking for further and further upside here. Um, and also, let me show you the weekly, right? Next targets on the DXY would be around March 2020 highs. So there's a room for a nice move to the upside here, right? Counting, of course, pullbacks or deep pullbacks um, in this market. So trade safe, and yeah, I'll see you next
Guys,
week.
my sincere apologies. This thing just disappeared off my screen and I couldn't bring it back, whatever. I hope you got the idea of what was going on there. If not, then my sincere apologies once again. The control panel is just completely giving me a hard time today. And again, for that, I do apologize. So what I'm going to do now is give you my interpretation of what the heck is going on here in terms of my technical analysis. So let's go on with that, and hopefully we'll find George somewhere very, very shortly as well, and give you what he's looking at for the coming week. Now, I've got a few things to look at, and very, very obvious changes that I have seen in the market this week. Starts with the Aussie, and we've got what I normally look at each and every week is exactly what I showed you before. Those candles that have closed as definitive directions, in other words, those candles who have put in a new high and closed on a new low, or the reverse of that, put in a new low and closed on a high. The most obvious one of those this week is Kiwi yen, but I'll get to that in a sec. I'll start where it all began, up the top in alphabetical order, with the Aussie pairs. The Aussie pairs had a bit of a shocking week last week, as the Aussie came off its highs, has been quite strong, but interestingly, against both the Swissy and the yen, we found that we had a risk on currency, the Aussie, versus a risk off currency, the yen and the Swiss, reversing. But it's tried to do that twice before in the last 3 weeks, or 4 weeks, if you like. One here, one here, one here. Now, that can tell me a couple of things. One is that every single time it tries, it fails, suggesting that the next direction will be short. Or, wow, it keeps on pounding this level. Surely at some stage it's going to break through. Look, I prefer the former rather than the latter, not necessarily from either a fundamental point of view or a technical point of view, but this has just been going up and up and up and up and up, and so has pretty much everything against the yen and the Swissy. Certainly the risk on currency. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of the last 12 weeks have been bullish. Surely this has to retrace at some stage. Of course, there's no such thing as certain, but if I'm erring on the side of caution, then I'm saying, okay, I want this to go. I can see that this has got to retrace. And the best way for me to capture that is to look at the tops, wait for a lower high, underneath here and then look to go short. Does it go all the way? Great question. I don't know. Which is the best of those Aussie pairs is the question that I ask myself. Is it Aussie Swissy? Is it Aussie Yen? Or is it indeed Aussie Kiwi? Well, when I see Aussie Kiwi, all I see is one reversal bar. When I look at Aussie Yen, all I see is one reversal bar, coupled back here, but it took out those highs. When I look at the Aussie Swiss, I see 1, 2, 3 reversal bars as I just described. So if that's the case, then this is the best of the three, in my humble opinion. Tough to trade it down here, given the size of the candle and the potential support level at monthly pivot. But these potential direction indicators, which these candles are, to my mind, are not necessarily to be traded per se, but giving us a hint as to what direction the week will take. So for that reason, I can totally see that I want to go short. But do I want to go short here, or do I want to wait for a retracement and then go short? Or do I want to wait for a bounce off the monthly pivot, give me the lower high that I want, then go short? I think both of those options are far better than what's in front of me right now, given that the reward here is not necessarily what I would like to see, given the risk that I would have to take. So they're the Aussie pairs. Euro had a pretty decent old week last week, in particular against the CAD, where it came off the bottom here and closed on its high. Again, another game changer bar, as I call them. Key reversal bar, no question. But gee whiz, you're taking this on faith. And I'd have to say pretty much blind faith at that. Yes, the Euro's had a good week. Should it have more? Has it got the potential to rally even further? Great question. The candle's telling me yes. And if you're really keen on the Euro, this is probably not a bad one, but it's not my thing to just go long here. And of course, that can be painful if the market just takes off and keeps going because you miss the entry. But I'm more prepared to miss the entry than I am to lose on a bad trade. So I'd be waiting for, again, probably a lower high in here to make this a little bit more secure in terms of, okay, let's confirm the direction before we go. And I think that's probably the case here. So I can totally see the monthly pivot up there. Great target. It's also at a confluence area of this little low. So if we can find a way up to there on maybe a smaller time frame, then I think that would be probably the better of the Euro pairs. Certainly against the dollar, you've got to be thinking, and Orlando said as much, dollar strength is in abundance at the moment, and it's very, very difficult to trade against that. But I'm going to throw a spanner in the works here. And I'm going to go to the euro dollar chart and point out why I think that is not necessarily the case. And if I look at this chart here, this is the monthly chart on the euro versus the dollar. And this support level, this monthly trend line, is actually telling me that this is either break or bounce. So I don't know yet what's going to happen, to be fair. There is a close below that. This is all very blurry. So there is a close below that level. But now's the time to pay attention, in my humble opinion. What we need to see is a clear signal that the break of that level, the break of that monthly trend line, actually means something. Or does it mean that we get a false break off that level and we get the bounce that is potentially there? If I have a look at this chart, I'm in favor of that. Now, I can't give you a fundamental reason why that would be the case. In fact, I can give you probably 2 or 3 fundamental reasons why it wouldn't be the case. But I think it's, as I said, time to pay attention, because this is a monthly chart. It's had a beautiful separation here. It's had another beautiful separation here. And I can totally see this going to this level at some stage. So all eyes on euro dollar. As I said, I can't give you a fundamental reason why it would rally, but the chart is there, and what I see is the chart, and the chart's telling me there's a potential for this to bounce. It's not a fait accompli, because of course we could get the break and retest and then it falls into the abyss. But time to pay attention, as I said. I think for my taste, if you like, and my style and method of trading, the Kiwi pairs are probably far better than the Aussie pairs to me. And again, you've got a risk on currency versus a risk off currency. Kiwi versus the Swissy has given you a game changer or key reversal bar after, called a triple top if you want. That's a weekly chart. And we've had a rally back here. So that makes sense to me to go short. And I don't think that's the worst by any stretch of the imagination. If you want to trade these game changer bars, you've got a level down here that could be perceived as the next support level. It would contribute to that. And I think that's absolutely viable. I'm not fussed on trading a red-bodied candle short. That's not my thing. So I'd want to see a little bit of a rally here before I got short. So maybe on a daily chart, if I got that little bit of a rally back to these pivots, then I think that's then the time that I want to trade this short. But I think that's definitely on the cards. Is Kiwi yen a better conveyance than Kiwi Swissy is the question that I have. And thus far, I've got a very strong potential, but it's not complete at this point. The strong potential is for this to become a false break of that resistance level. So exactly the same applies. If I got a rally here back to, say, the trade line, but certainly the weekly pivot, I think this is a sell every day of the week. So Kiwi versus the yen is probably the one that I'm looking at. Again, it's very, very difficult from a fundamental perspective to be saying yen strength. Those two things in the same sentence at the moment don't seem to be logical. However, the chart's telling me something different. And just like the euro versus the dollar, fundamentally, it's not a viable proposition, but technically, I can totally see it. Again, completely overbought. So a retracement is definitely on the cards. So I think those two, maybe Aussie Swissy and Kiwi yen, are probably the two that I favour most so far this week. Of course, we do have a French election going on as we speak, and the euro pairs might be very, very difficult to trade early in the week as those results come in. So I'd be cautioning, I'd be counselling caution in that area around the euro. So let's just be patient there. All right, can we get to George? That's the big question. I'm trying my little. That was Orlando. Let me see if I can find George. He's definitely here. I can promise you that. I need to get off this screen for just a tick. So let me put this over here. You should be back to my screen now. And let me get rid of that. And try and find George, who should be up here somewhere. Okay, I think I found him. There he is. You can hear him in the background. All right, so guys, here he comes, and he's going to tell you all about what his new shows are. And as I said, 8 hours a day, amazing. Tell me if you can't hear, because this may be in exactly the same position as it was before, where I couldn't share. No, that's not working at all. Hang on 2 secs. We'll go to this screen. We'll share sound. We'll open that up and play.
Hey traders, my name is George, and I'm the host of the brand new show Wednesdays at the Market with George. Now, this comes to you the second Wednesday of every month. It's free to the public. You have 8 hours in the day that you can spend with me trading the markets, pure price action trading, looking at these 8 markets that you can see on your screen. Now, in addition to the Wednesdays at the market, which have to be in your diary, I mean, if you're serious about mastering this game, the second Wednesday of every month, you got to find an opportunity to trade with me in one of those 8 hours. But in addition to that, I also host the live trading profits show, also on Wednesdays, just outside of one of the slots. So it comes to 11:30. That's South African time to 12:15, and GMT time, which is a little bit different to London time sometimes because of time zone changes, 9:30 a.m. every Wednesday. So two shows that you can be with me on Wednesdays. Now, today, I want to talk about one of the things that I speak about quite often in the market when it turns up. And it's one of the bread and butter price action strategies that you ought to have in your arsenal if you want to make good returns as a price action trader. It's called Major Trend Reversal. Now, I call it Major Trend Reversal Alert. Price action traders call it MTR, but I put alert there because the market may not reverse. It may just continue doing what you're doing. Now, the one thing that I always talk about when I'm presenting my shows, and I'm a host. Thank you to Geoff, who is your host today. I'm also a host on his show with Ash, the Trading Buddies, on Mondays. I'm always talking about the fact I only want to trade when I'm 100% certain that the market is going to do what I want it to do. So when I'm looking for trends, I know that 100% certainty is going to go my way 60% of the times. And I'm very comfortable with that. And I can make money out of that quite comfortably as well, 1-to-1, 2-to-1, whatever the case may be. But also there's another strategy which allows me to make a lot more money than I do out of trends. It's this strategy, the major trend reversal, if I can get it and jump into it. Now, I want to jump into major trend reversals when I get the alert, and I'm 100% certain it's going to go my way 40% of the times. So lower probability, higher profits on major trend reversal alerts. On trend trades, higher probability, less profits. But that's a discussion for another point. I want to talk about major trend reversal alerts. Now, here's the setup that I'm always talking to traders about. Whenever you get to trade, if you trade the 5-minute chart, which I do, the very first thing is you want to jump at the beginning of the day to your daily chart and make sure the daily chart is set up properly, because those key levels of support and resistance, what's happening on the daily chart, it's going to have a determined influence on the 5-minute charts, which builds up to the daily chart. So here's my daily chart setup on the euro versus the dollar. I'm not going to spend a lot of time on it. I want to drill down to the day I want to look at. Now, the day I'm going to focus on is what happened on this particular day, which is the 21st of April. So on my daily chart setup, everything is set up, highs, lows, etc. But I want to go always, then I go to the 3 days analysis, the past 3 days, the previous 3 days of the day I'm trading. So I've been trading this day, the previous day is this bull candle. Then there's a second day before that and the third day before that. So these 3 days are very key, as they give me more information in terms of what to expect today, in terms of whether I'm going to just trade trends or reversals. Quick look at what's taken place. If you just look to your left, there is this day, which was the 14th of April, a huge trading range day. Why is it trading range? Tails on the bottom, tails on the top. And you can see that has influenced the market since then. So as I'm coming into the day, I look at the previous day, bull candle. So bulls are strong enough to come out of the bottom of a trading range. So what do bulls want to do if you're in the middle of a trading range? We're in the middle of this trading range here. Bulls obviously want to push the market up and show strength and hopefully break out to test this descending trend line. Bears want to defend that middle of the trading range. Whatever happens, bears want the market to come down to this level, and their hope is to break beneath that. But because you're in a trading range, on the trading range rules, you want to buy low whenever in a trading range, and you want to sell high. So whatever happens during the day, if the market breaks up, I'm going to make sure that I am in that trend. And when we get to this level of resistance, there's a level of resistance here, which is I have that trading range, but there's also multiple levels of resistance ahead, which makes this whole zone a selling zone. Here's one here, which is measured move, trading range, breakout range of yesterday. Bit of an acronym, but all it means, one of our setups every day, high of the previous day, green line, low of the previous day, red line. I always want to put my feedback extension in to see what the measured move of the breakout of the trading range of yesterday is, because yesterday's high and low creates a trading range of yesterday. And if the bulls break out of it, their primary goal is to get to a measured move of that trading range, which is what we have right up here. Measured move, trading range, breakout, range of ROID range of yesterday. So that's another level of resistance likely to pull the market up. But there's another level which is just here. If you have a look, this was the low of March 2022, strong breakout by the bears. Whenever any level is broken out, the market likes to come back and test that. So all of this is attempt to test that breakout point. So that's a key level of resistance that is likely to pull the market up. So you've got three levels: high of that trading range, this low of March, and then the measured move. Very strong magnets that can pull the market up completely. So when I then drill down to my 5-minute chart, I've got all of those set up, and I jump to the 5-minute chart. And let's just do that quickly. So it's the 21st of March. Oh, I just put something, but don't worry about it. 21st of March. There is the 21st of March. Okay, now because I want to focus on the major trend reversal alert, I'm not going to worry about what happened here, huge opportunities for you. But there are a few things on the major trend reversal alert that we need to always bear in mind. Let's put it here, major trend reversal. And I call it an alert because although I'm 100% setting out in terms of my strategy, it's only going to go my way 40% of the time. So I know that 6% of the times will go against me, and I just manage it. Okay, and there's 5 distinct little steps to it. Number 1, you need to see a trend. There is a trend. It's a major trend reversal, which means you're breaking a trend. So there is a trend. Clear trend that we see. There is a trend, then you need to see a break of the trend line. When you see a break of the trend line, it means a high has been created. That's number 1. So there is a high, there is a break of a trend line. Okay. Once a break of a trend line has occurred for whatever reason, the market has reached those multiple, that area, the sell zone that I spoke about, which is these multiple confluence fixtures, high of the trading range. This was the breakout point. Remember that low of March, and then the measured move of the trading range. So in a deep sell zone, the market has been pulled out to that. Bulls taking profits, bears trying to sell. So break of a trend line. But after the break of a trend line, I want to see a moving average gap bar, what we call a moving average gap bar. That's the bears have managed to put a candle completely with a gap to the moving average. And I use this thick line to indicate the strength of the trend. So they've broken through the strongest part of the trend, and they've put a full candle beneath the moving average. So the bears are strong enough to do that. But then, of course, the market is going to resume to try and test that. The market does that most of the time. So the bulls want to buy again. So okay, we've taken some profits. Let's see if we've got strength. Let's test the resolve of the bears. So from there, we have a moving average gap bar, and it must be a candle that is completely beneath the moving average with a gap beneath it, moving average gap bar. So the market resumes to try and test that level. If the bears are strong, they're going to turn the market down and create a lower high. There can be variations to this, which I'm not going to talk about, to make it a little bit more complex, higher highs, etc. But let's talk about a lower high in this case. So high, break the trend line, moving average gap bar. Number 2, attempt to resume the trade. The bears come in, reverse the process again, create a lower high. So you could sell there. You could sell beneath number 3. Just make this red because it's a bear trend. Bear major trend reversal. So you could sell there quite legitimately. If you do that, your stop has to be at a technical level. And I always put my stop at a measured move. Your stop has to be there because this is a trading range. If we break out above that, that's where the magnet is. Okay. And that's where they want to go. So just put your stop above that. You know, if something else sets up, you can still sell. 1, 2, 3. Then you want to see the strength of the bears and the bears now resuming the trend. I want to see now another a strong break beneath the 20 EMA. That's a 20 EMA. Okay, first one was a 10. So it's a weaker part of the trend, but still a trend nonetheless. There we have it. There is number 4, break beneath the 20 EMA. And we can see moving average gap bars, bears strong enough to put close beneath the 20 EMA. Then I want to see another attempt to resume by the bulls and look for a lower high double top, whatever it is that the market may give me. In this case, we get a lower high. The fact that it's a bull pen is not a problem. You're in a major trend reversal. I'll let 40% chance, so it's not going to be perfect, but you must take a trade. In this case, I can now take a trade here. So if I haven't taken that trade, number 3, sorry, that is a mistake. You see that should be 5. If I haven't taken the number 3 trade, you can take number 5 trade. A lot more certainty, but a lot less profit. In this case, you would put your stop above here. You're not going to put your stop at the measured move because now you have a series of lower highs. So in that case, you put your stop above there. So those are the ingredients of a relatively straightforward major trend reversal alert. They get more complex, higher highs come in, wedges come in, all sorts of things come in. But from there, you can see now you have a strong breakout by the bears from that lower high. Look at all my numbering. Probably asking, where did this guy go to school? 1, 2, 3, 4, 4, 4, 5. Okay, 1, 2, 3. You trade up beneath the 3, or you can trade beneath the 5. Breakout, fantastic. Now we are in the bear trend. If you don't trade these 40% probabilities where you get a lot more profit, you wait for the trend, then you look for opportunities to get it. But today was talking about the major trend reversal alert. I look forward to seeing you Wednesdays at the market with George, the second Wednesday of every month. All the details are on the Actions to Wealth website, social medias. But there's also the 3rd and 4th Wednesdays, which you can access by subscription, and a lot more exclusive, a lot more detail shared. Look forward to chatting with you guys on Mondays as a guest at Geoff and Ash show, Trading Buddies. Take care, Geoff. Thank you very much. I know you're hosting this. Thank you, buddy. We'll catch up with you guys. Bye-bye.
Thank you, George. Good mate, George. And as always, excellent education that we're seeing there from him. And as he said, he'll be catching up with us tomorrow.
Ready to simplify your online learning?
Stop that.
Us too.
My goodness me. The control panel is just giving me a really hard time today. And as you can see, you can't see me. And I've tried everything to get myself on camera. Honestly, I know the camera breaks sometimes when I get in front of it, but this is not one of those times. Well, maybe it is one of those times. Maybe I've broken the camera. Okay, guys, that's the show for today. My apologies for the hiccups that have appeared from a technical point of view. You wouldn't believe, would you, that once upon a time I used to put television programs on the air. I used to be a television director. Oh dear, those days are gone. And it all went seamlessly then. It didn't go seamlessly today, for which I do apologize. However, we're going to leave you with the message that in Australia and New Zealand tomorrow, if you're Australian or a New Zealander, we do have Anzac Day, which is a very special day for us, which commemorates those who have served and given the ultimate sacrifice through wars past. Let's hope there's not one that happens present. That would be good. Have a wonderful Anzac Day, those of you who are Aussies and Kiwis. Go out and thank those who served. They certainly deserve it. For the rest of you, have a great week ahead, and we'll see you this time next week, of course, with another Sunday market update. And those of you who are into Trading Buddies, we'll be doing it all again tomorrow. Thank you very much, guys, for the happy Anzac Day wishes. Have a great week ahead. Bye-bye for now.